close your eyes. It's Thursday, October 24th, 1929. You're a clerk in Manhattan, 32 years old, a wife, a kid, a rented apartment on the east side. And on paper, you're doing well. $2,000 in stocks, roughly $35,000 in today's money. There's just one problem. You didn't pay for most of it. You bought on margin, borrowed money, like millions of Americans did. Now open your eyes. Over the next 7 days, you will face 3 decisions. Get them right and your family survives. Get them wrong and you lose everything. And most of the people around you are about to choose wrong. 7 a.m. You take the subway downtown like every morning, but something is wrong. By the time you reach Wall Street, there's a crowd outside the exchange. Hundreds of people, silent, staring at the building. Inside, the market is falling, fast. Prices that took years to climb are collapsing in minutes. And here's the detail that turns fear into panic. The ticker, the machine that prints stock prices, can't keep up. It's running hours behind the actual trades, which means nobody knows what their stocks are worth right now. You could already be ruined and not find out until dinner. This is your first decision. Around you, men are fighting to sell at any price. A share worth $80 this morning might fetch $50 by noon. Nobody knows. Your broker's office is packed. Do you push through and dump everything? Or hold your nerve? Here's what you can't see from the street. Volume today will hit nearly 13 million shares, a record. Fortunes are evaporating by the minute, and then, just after noon, the crowd goes quiet. Word spreads the heads of the biggest banks in America are meeting at J.P. Morgan and Company, right across the street. The most powerful men on earth are about to walk onto that trading floor. And what they do next will decide whether you panic today or lose everything next week. Quick pause before the bankers make their move. If you want to survive more days like this one, crashes, collapses, entire empires falling apart, subscribe. It genuinely helps this channel keep making these. Now, back to Wall Street. 1:30 p.m. Richard Whitney, vice president of the exchange, walks across the trading floor and loudly bids for 10,000 shares of U.S. Steel above the market price. It's theater, deliberate, expensive theater, backed by a pool of money from the big banks. And it works. The panic stalls. Price is steady. By the close, the market has clawed back most of the day's losses. You didn't sell, and tonight, you feel like a genius. Friday's newspapers agree with you. The headlines are calm, almost cheerful. Bankers say the worst is over. Analysts call it a healthy correction. Saturday morning, your neighbor knocks on your door. He's grinning. He's just borrowed more money to buy stocks. Everything's on sale, he tells you. The smart money is buying the dip. He asks if you want in. Here is the cruelest thing about this weekend. Everything you're hearing sounds reasonable. The bank stepped in, the papers are calm, prices bounced. Every signal says the danger has passed. But you, watching this from almost a century away, know something that clerk cannot. The banker's rescue bought exactly 1 day. The selling pressure hasn't gone anywhere. It's just waiting for Monday's opening bell. So the real second decision isn't whether to buy the dip. It's whether you can do the hardest thing in a crisis. Nothing at all, except quietly getting your cash somewhere safe. Because Monday is coming, and Monday has no bankers. Monday, October 28th, the opening bell rings at 10 a.m. And this time, there is no rescue. No Whitney, no banker's pool, just selling. Wave after wave of it. By the end of the day, the Dow has fallen roughly 13%, one of the worst single days in its history. That evening, your phone rings. It's your broker, and he uses the 2 words every leveraged investor dreads: margin call. Here's what that means for you. You put down $500 of your own money and borrowed $1,500 to buy $2,000 of stock. The stock was the collateral. Now the stock has crashed, the collateral isn't enough, and the broker wants cash tonight, or he sells everything you own at whatever price he can get. This is decision 3, and it's the one that destroys people. Option 1, scrape together every dollar you have, your savings, money borrowed from family, and wire it to the broker to hold your position. Option 2, refuse. Let him liquidate. Take the loss. Walk away with whatever's left. All around the city, thousands of men choose option 1. They empty savings accounts. They pawn jewelry. They pour their last reserves into a falling market. Because surely, it can't drop again. Tuesday, October 29th, 1929, Black Tuesday. The market doesn't just drop, it disintegrates. Another 12% gone. Over 16 million shares traded, a record that will stand for decades. In 2 days, the Dow has lost nearly a quarter of its value. Tens of billions of dollars then, hundreds of billions in today's money. The men who met the margin call on Monday night, they didn't save their stocks. They just handed the market their savings too. Everything gone in 48 hours. And you? That depends entirely on which option you chose. And on one quiet trip you may or may not have made this morning to your bank. So let's break down the week. Who actually made it out and how? The people who survived had broadly three things in common. First, no margin debt, or they cut it fast. Investors who owned their shares outright had a terrible week on paper, but nobody could force them to sell. Time was on their side. Leverage is what turned a crash into a wipeout. Second, they treated cash as survival, not as missed opportunity. The clerks and shopkeepers who quietly pulled money out of harm's way that week looked paranoid on Friday. Within a few years, as thousands of American banks failed and depositors lost their savings, they looked like prophets. Third, and this is the counterintuitive one, the survivors did less, not more. They didn't buy the Friday dip. They didn't double down on Monday. In a panic, activity feels like control. Usually it's just faster ruin. Now the other side. The famous losers of 1929 were rarely poor men. They were confident men. Speculators who had made fortunes on borrowed money and assumed the game would never end. Some reportedly went from millionaires to bankrupts within weeks. Press accounts from the era described fortunes wiped out almost overnight. Even Richard Whitney, the hero of Black Thursday, would later fall spectacularly. Convicted of embezzlement in 1938. And your neighbor, the one buying bargains on Saturday, he was following the single deadliest idea of that week, that a market that has fallen must be cheap. It kept falling for nearly 3 more years, eventually losing around 90% of its peak value. The pattern is brutally simple. The losers bet on the market recovering quickly. The survivors bet on themselves surviving slowly. In October 1929, that difference was everything. Friday, November 1st, 1929. 1 week after you woke up to that crowd on Wall Street, let's say you played it well. You didn't sell in Thursday's panic, but you didn't buy the weekend bargains either. When the margin call came, you refused to throw good money after bad. You took your loss, kept your cash, kept your job. On your block, that makes you one of the lucky ones. Men who were rich 7 days ago are now settling debts with their brokers. Your neighbor doesn't grin anymore. You survived the week. But here's what nobody standing on Wall Street that Friday could know. The crash wasn't the disaster. The crash was the trailer. Over the next 3 years, the market kept sliding, down roughly 90% from its 1929 peak by the summer of 1932. Thousands of banks collapsed, taking ordinary depositors' savings with them. Unemployment climbed toward 1 in 4 American workers. The clerks who dodged the crash still had to survive the Great Depression, a slower, grinding catastrophe that punished entirely different instincts. Which brings us to the real lesson of this week, and it isn't about stocks. Almost nobody was destroyed by falling prices alone. They were destroyed by what they did about falling prices. Borrowing into a bubble, panic selling at the bottom, doubling down out of pride, trusting the reassuring headline over the uncomfortable math. The market crashed in October 1929, but for most families, panic did the killing. Panic and debt, and the desperate refusal to accept a small loss before it became a total one. The crash took days. The choices took minutes. And if you think surviving 1 week was hard, the next challenge is surviving 4 years. Breadlines, bank runs, and the slow-motion collapse of an entire economy. Waking up in 1930 is a very different game. That's the next video. Bring your cash.